You know, the market never gives you a gift. It never hands out easy money wrapped in ribbons. Every dollar you take out of it, you'll have to earn by understanding its language. And most traders, they never quite learn to listen. They rush, they anticipate, they trade on what they hope is a breakout, instead of what the market is actually telling them. That's why today we're going to talk about something that every serious trader must master, the confirmations every real breakout needs. Now, if you've been following along since the previous video on how to spot breakouts early, you already know that timing and observation are everything. Spotting a possible breakout is one thing, but confirming it, that's where the real money is made. You can't build your fortune on guesses. You've got to build it on evidence, on the tape, on what the market itself confirms. Let me tell you something I learned early, back when I was just a boy in the bucket shops. The tape never lies. The people do. The emotions do. But the tape, never. It tells you everything you need to know if you're willing to wait and read it right. And when it comes to breakouts, it'll whisper to you before it shouts. The trouble is, most traders can't wait long enough to hear the whisper. They're too busy wanting to act. Now ask yourself, how many times have you seen a stock break above a line on your chart, and your pulse quickens, and you think, that's it! It's breaking out! You buy in, and before you can even call it a trade, it collapses right back below the same line. You sit there wondering what happened. The market didn't fail you. You failed to demand confirmation. A real breakout, my friend, is not just about price moving past a line. It's about behavior, of price, of volume, and of participants. It's about the shift in control from weak hands to strong ones. And those confirmations are your only insurance against being the fool who bought the top of a fake move. I've seen men ruin themselves because they confused motion with meaning. Just because a stock moves doesn't mean it's going anywhere. Every day, prices move. Every day, there's noise. But a trader doesn't get paid for reacting to noise. He gets paid for reading intent. Do you see the difference? Here's something I always told myself. A real breakout has to prove itself. The market owes you no promises. You wait for proof. Proof in the way price holds above its old resistance. Proof in the way volume expands when it should, and contracts when it should. Proof in the way weak holders start to disappear and strength begins to replace them. These are the confirmations every breakout must show you before you trust it with your capital. Patience in trading isn't laziness. It's discipline. And discipline is what separates a trader from a gambler. Gamblers want excitement. Traders want confirmation. When I'd see a stock nearing a level it hadn't touched in months, I wouldn't jump in just because it crossed the line. I'd wait to see how it acted after it crossed. Would it stay firm? Would the public rush in while professionals quietly took profits? Or would the professionals be accumulating even more? The answers lie in the confirmations. Volume, for instance. Volume is the market's voice. It tells you who's talking, the crowd or the professionals. When a stock breaks out on heavy volume, it's a sign that demand is there. But you don't want just one day of volume. You want consistency. You want to see volume stay active as price moves higher, not just a single burst of emotion, because emotional volume dies as quickly as it appears. Now, many traders, especially new ones, think that every breakout has to come with massive volume. But that's not always true. Sometimes the best breakouts are quiet ones, the kind where volume increases subtly, where the professionals are moving in without drawing attention. That's why you have to look deeper. Are the up days coming with slightly higher volume than the down days? Are pullbacks showing less activity? That's the kind of confirmation that separates the true move from the false one. Ask yourself right now, when you look at a chart, are you looking at price, or are you reading behavior? Because the difference between those two is the difference between hope and understanding. There's another confirmation you must never ignore. The test. A real breakout always gets tested. It's like a boxer who lands a punch but must prove he can take one too. After a stock breaks above resistance, it will often pull back to that level to see if it holds. That's where most traders lose patience. They think the move is over, But in truth, the market is just testing its new footing. If it holds above that old resistance, if volume dries up on the pullback and demand returns on the next push, that's your confirmation. I've watched this happen thousands of times. I'd see a stock break its resistance, then drift back, and I'd sit there watching the tape. I'd see whether the bids stayed firm, whether selling pressure weakened. That's what told me the move was genuine. The test always tells the truth. If it fails the test, you walk away. If it passes, you have your signal. Remember, no confirmation, no position. That rule alone could save you from ruin. You don't have to catch every move. You only need to catch the ones that prove themselves. You might ask, but Jesse, won't I miss out if I wait too long? No, my friend. The market isn't a train that leaves without you. It's a theater that opens its doors every day. There will always be another show. Your job isn't to chase. It's to recognize the shows worth buying a ticket for. And a real breakout, one with true confirmation, will give you time to act, because real trends don't fade overnight. Now let me tell you something about the psychology behind confirmations. Most traders are eager to be first. They want to be early because they think that's where the profit lies. But early is often wrong. I learned that the hard way. Being early without confirmation isn't being smart. It's being reckless. I once bought into moves that looked like they were breaking out, only to see them turn on me within hours. What I learned was that the market doesn't reward guesses. It rewards patience backed by proof. Do you know what separates the amateurs from the professionals? The amateurs buy the breakout. The professionals buy the confirmation. Let's talk about price behavior for a moment. When you're studying a breakout, watch how price behaves after the level is breached. Does it surge through and keep running? Or does it poke above, then stall? A real breakout doesn't hesitate too much. It moves with intent. But it also doesn't explode too far too fast, because controlled buying has logic behind it. If price spikes wildly and then reverses, that's emotion, not control. You want to see strength that's steady, measured, confident. When I was watching the ticker back in my day, I could feel when a move had conviction. You can feel it today too, even with all the charts and screens. The rhythm of the tape, the pace of price, the tone of volume, it all tells you if the move is genuine. But you've got to be tuned in, not distracted. You can't confirm a breakout if your mind is bouncing between tickers and headlines. Think about this. Do you want to be the trader who reacts, or the trader who recognizes? The one who trades signals, or the one who trades confirmation? And here's another thing. Confirmation isn't just technical, it's psychological. When a real breakout happens, the crowd's behavior changes. You'll notice more talk, more excitement, but also more disbelief from those who missed it. The best moves often start when the public is still skeptical. If everyone's already in, who's left to buy? Confirmation comes not from what people say, but what the market does. Now, if you remember our discussion from how to spot breakouts early, we talked about identifying the signs before the move, the tightening of ranges, the contraction of volatility, the quiet accumulation under the surface. What we're talking about today is the follow-through. The market gives you early signs, yes, but then it gives you confirmation through follow-through. Early spotting gets you ready. Confirmation gives you permission. You see, a breakout setup is like a loaded gun, but confirmation is the trigger. Without confirmation, it's just potential energy. You only pull the trigger when the market proves it's ready to fire. Otherwise, you'll be shooting blanks. Let's talk about one of the most overlooked confirmations. The reaction of other stocks in the same group. When a leader breaks out, look around. Are the others in the same sector supporting the move? Or are they lagging behind? Real strength never travels alone. If you see one name making new highs, but its peers are flat or falling, be careful. That's not confirmation, that's isolation. True leadership shows up in the whole group, not just one brave soldier running into battle alone. You'd be surprised how many traders ignore this. They think all they need is one chart. But the market doesn't move in isolation. It moves in harmony. When a whole industry starts to lift, that's when you know the tide's turning. That's confirmation from the broader market. I always said, a stock's behavior tells you everything about the market's mood. But the market's mood isn't confined to one stock. When you see multiple charts forming similar structures, similar breakouts, similar volume behavior, that's the market confirming the trend for you. That's when you can act with confidence. Now, here's a subtle but powerful form of confirmation: time. The longer a level holds before a breakout, the more important it becomes. And once price breaks that level, the longer it stays above it, the more reliable the move. Time validates price. When a breakout sustains itself over several sessions, with orderly behavior and healthy pullbacks, you've got confirmation that real demand exists. Ask yourself, do you measure your trades in ticks or in time? Because traders who think only in price forget that time is the second half of the equation. Let's get back to behavior. When a breakout occurs, one of the best confirmations is what happens on the first pullback. That's where weak hands get shaken and strong hands step in. Watch how it behaves on that retracement. Is the selling weak? Is the volume lower than it was on the breakout? That's a sign that sellers are drying up. When buying resumes afterward with renewed strength, that's the market confirming your thesis. And don't overlook what happens to volatility. In a true breakout, volatility often contracts before the move. That's the coiling we talked about in the previous lesson. But after the breakout, volatility can either expand sharply, as if the move is emotional, or remain controlled as if the move is professional. Controlled volatility is the hallmark of a strong, sustainable breakout. The reason confirmations matter so much isn't just technical. It's psychological protection. When you demand confirmation before you act, you remove the guesswork. You remove emotion. You remove the part of your brain that wants to gamble. You force yourself to be objective. Ask yourself honestly, how many of your losing trades came from waiting for proof versus acting on impulse? You already know the answer. When you train your mind to wait for confirmations, you're not just protecting your capital. You're training your patience muscle. And that patience will serve you in every other part of trading. Pyramiding your profits, cutting losses, managing risk, because the same discipline that waits for confirmation also waits for exit signals, for distribution signs, for market reversals. It's all connected. Breakouts are the glamour part of trading. Everybody loves them. But confirmations are the work. They're not as exciting. They don't make headlines. But they're where the money is preserved and multiplied. I remember once during a bull campaign, there was a stock that had been coiling for weeks. Everyone on the street was watching it. It broke out one morning, and the crowd went wild. I watched the tape. It moved fast, too fast. Volume was chaotic. By afternoon, it was already reversing. I didn't touch it. 2 days later, it was back below the breakout level, trapping everyone who chased it. Then, quietly, volume started to build again. Price climbed back up, tested the level, and this time held firm. Volume was steady, controlled. That's when I bought. And that move lasted for months. The difference was simple. The first time was noise, the second time was confirmation. Do you see what I mean when I say the market repeats its behavior, but few traders repeat their lessons? If you take one thing from this, let it be this: the confirmation is your compass. It doesn't guarantee success, but it guides you away from danger. And avoiding danger in this business is half the battle. The other half is courage, the courage to act once confirmation appears. Because too many traders wait, and by the time they believe it, the move's already far along. Confirmation isn't hesitation, it's readiness. Once you see the proof, you act. Now, let's tie this back to what we discussed before about early spotting. Early spotting shows you where to look. Confirmations tell you when to strike. One without the other is incomplete. You can't confirm what you can't see, and you can't profit from what you don't confirm. That's the full circle of breakout trading. Remember, in trading, your goal isn't to predict. It's to recognize. The confirmations are recognition tools. They tell you that the move is real, that the odds are in your favor, that the market's tone has shifted from potential to performance. You'll find that when you master the art of waiting for confirmation, Your stress drops. Your confidence rises. You no longer feel like you're chasing moves. You feel like you're following logic, and logic, not emotion, is what builds lasting wealth in the market. You won't always be right, of course. Even confirmed breakouts can fail. But you'll be less wrong less often, and that's what makes all the difference. Because surviving the wrong ones is what keeps you in the game long enough to catch the right ones. Ask yourself, are you trading to feel right or to make money? Because the trader who needs to feel right will jump at every signal. The trader who wants to make money will wait for confirmation. Most traders don't lose because they can't find opportunities. They lose because they can't wait for proof. They act on anticipation instead of confirmation. They're driven by fear. Fear of missing out, fear of being left behind. But the market rewards patience, not panic. In the long run, the confirmations you demand will define the consistency of your results. Every great trend in history, every great campaign I ever participated in, had the same ingredients: a base, a breakout, and confirmation. Without confirmation, it's just noise. With it, it's the beginning of wealth. And the beautiful thing is, confirmations aren't hidden. They're right there in front of you, on every chart, in every ticker every day. The market shows you the evidence. The question is, are you disciplined enough to wait for it? A breakout without proof is just price noise. That's the truth most traders learn only after they've paid tuition to the market. You see, the charts are full of movements that look meaningful, but aren't. Lines break, prices surge, candles stretch, and traders rush in thinking they've caught the start of a new trend. But without confirmation, that move is nothing more than a whisper in a storm. It's motion, not meaning. The difference between those two can make or break your trading account. When a stock or a market index pushes above a resistance level, the untrained eye sees opportunity. The trained eye sees a question: is this genuine strength or just noise? And that question must be answered before you risk a single dollar. You can't treat every price movement as truth. The market plays tricks on impatience. It knows how to fake strength, how to lure the crowd into false breakouts, and how to punish those who can't wait for proof. I've seen countless traders buy the first tick above resistance as if the chart itself had promised them profit. They forget that the market doesn't honor promises, it honors discipline. A price move becomes a breakout only when it proves it can stay above the level that once held it back. Until then, it's a child testing boundaries. Loud, impulsive, unpredictable. You wouldn't hand your fortune to a child, would you? Then don't hand it to an unconfirmed breakout either. Noise in the market comes from emotion. The fear of missing out, the greed of early entry, the excitement of being right. Confirmation filters out that emotion. It separates the traders who listen from those who react. When you look at a price spike and see volume rising erratically, when you notice that momentum surged on news or rumor, ask yourself, is this sustainable interest or just emotional noise? Because if the crowd is buying out of excitement rather than conviction, that price will fade as fast as the emotion that created it. I learned early that the market's first move is rarely the real move. The first push through resistance is often a test. Professionals watch how it behaves after the break. Whether it can hold, whether volume supports it, whether selling dries up when price pulls back. That's where the truth lies. The crowd trades the breakout, the professional trades the confirmation. The difference between them is the difference between luck and skill. Think of it this way: a genuine breakout is the start of a new story. But before the story unfolds, you want to make sure it's not fiction. Proof comes in structure, not excitement. If the price shoots up and immediately stalls, if volume surges for a day and then disappears, if the next session brings a reversal, that was just noise. The market was teasing. Real breakouts build pressure over time and release it gradually, not chaotically. The move looks clean, not erratic. It holds the level it conquered. That's proof. Ask yourself, how many times have you jumped into a move that looked strong, only to see it reverse within hours? Did you check for proof? Or did you assume that every surge meant a trend? The difference between those two questions could have saved you thousands. Noise is dangerous because it pretends to be opportunity. It looks the same on the surface. A breakout candle, a volume spike, a resistance breach. But what confirms a real breakout is what happens after that candle closes. Can it attract follow-through buying? Can it maintain momentum without collapsing under its own weight? Can it withstand a retest without giving back all its gains? Only then can you separate the genuine from the fake. Most traders lose money not because they can't find breakouts, but because they mistake noise for confirmation. They see motion and assume intent. They want to believe that the market is offering them a chance to get rich quickly. But trading isn't about belief. It's about evidence. Without proof, you're not trading, you're guessing. And guessing is just another form of gambling dressed in technical analysis. In my own campaigns, I never trusted the first move. I waited for the market to prove it meant business. I'd see a stock break out of a range, but instead of rushing in, I'd watch the tape. Was buying continuous or did it fade? Were the large interests participating, or was it just the public chasing headlines? Those small observations were the difference between catching a trend and getting trapped in noise. Sometimes, proof doesn't come immediately. The price might break out, then pull back, then hover around the new level. That's where patience pays. If it holds firm, if selling pressure remains light, if demand quietly builds again, that's proof. But if it collapses back into the old range, it was never a breakout, just noise amplified by excitement. The market gives you the clues. Your job is to read them, not rush them. Every false breakout has one thing in common: it looks convincing at first. That's what makes it dangerous. The noise is seductive. It's fast, dramatic, emotional. Confirmation, on the other hand, is boring. It's calm. It's patient. It takes time to form. But trading rewards boredom far more than excitement. The quieter the confirmation, the stronger the move. Let's be honest. Waiting for proof is uncomfortable. The human mind hates waiting because it fears missing out. You see price move and think, if I don't buy now, I'll miss it. But what you're really missing when you jump in too soon is the chance to verify whether the move is real. Missing one fake breakout will never hurt you. Buying into one can. Ask yourself again, do you want to be right now or do you want to be right later? The market doesn't care about timing your ego. It cares about timing your evidence. A breakout without proof is like a rumor without facts. It spreads fast, makes noise, gets attention, but collapses the moment you question it. The same principle applies to price. The crowd believes what it wants to believe. The professional believes what the market confirms. Proof can come in many forms. Holding above the breakout level, consistent volume, controlled pullbacks, rising relative strength. But without at least one of these confirmations, you're dealing with nothing more than noise. The ticker tape might look alive, but it's just chatter until the market proves commitment. I've seen traders build their entire strategies around chasing these unconfirmed moves. They make a little, they lose a lot, and they never understand why. The answer is simple. They're trading sound, not signal. They're reacting to movement, not substance. The market doesn't reward motion, it rewards direction confirmed by participation. You'll find that when you stop reacting to every tick and start demanding proof, your trading slows down, but your results improve. You'll make fewer trades, but better ones. The noise will fade, and the picture will become clearer. That's when you realize that the market isn't as chaotic as it seems. It's just full of impatient people mistaking movement for meaning. And once you see that truth, that a breakout without proof is just price noise, you start to trade differently. You stop chasing shadows. You stop buying hope. You start reading the market for what it is, not what you want it to be. Volume must confirm intent, not just emotion. That is one of the most overlooked truths in trading, yet it's one of the most critical to understand if you hope to survive and thrive in the market. Many traders think they can judge a breakout simply by looking at price. They see the candle stretch above resistance or below support and immediately assume that the move is genuine. But price alone tells only part of the story. It tells you what happened, not why it happened. The why comes from volume. Volume is the market's heartbeat. It reveals the presence of conviction. It distinguishes real interest from temporary excitement. It separates intention from impulse. I cannot stress this enough. Without volume confirming the move, price is merely motion. Motion without intent is noise. The market is full of moments where price jumps or drops with great drama, but if there isn't accompanying volume to show that actual demand or supply is behind it, the move is unreliable. Emotional buying, speculative frenzy, and short-term excitement can create spikes that seem like breakouts, but they rarely sustain. That's why volume is the trader's most reliable indicator of intent. When a breakout occurs with strong, steady volume, it tells you that participants are serious. When it occurs on light or erratic volume, it tells you that the market is uncertain, hesitant, or being manipulated by small bursts of emotion. Ask yourself this: how many times have you jumped on a breakout only to see it collapse the next day? Did you check whether the volume supported the move, or did you buy because the candle looked impressive? Most traders fall into the trap of judging moves by appearances. They react to the visual drama of the market, not its substance. Volume is substance. It is evidence that the move is backed by participants who are willing to put real money behind it. Volume must be considered relative, not absolute. One day's heavy volume is only meaningful if it's heavier than the preceding days. The market communicates in context. A surge in volume that looks impressive by itself might actually be weak compared to the activity that preceded it. Conversely, a modest increase in volume might signal real strength if it shows a consistent rise over several sessions. The key is to read volume as a language, not a number. You're listening to what the market says, not just counting how many shares changed hands. Another point often missed is the timing of volume. Volume should increase as price moves in the direction of the breakout. If price rises but volume lags, it suggests that the move lacks genuine support. Conversely, if volume surges before or during the breakout, it signals that the market is committed and ready to continue. Volume is like a voice that tells you who is driving the move. Is it the professional money moving quietly but decisively, or is it the crowd chasing a rumor? The answer lies in observing how volume interacts with price. Emotional volume can be dangerous. It's often loud, chaotic, and short-lived. You see it when a stock gaps up on headlines or reacts to speculative chatter. Traders get excited, buy impulsively, and the move looks like a breakout. But when the excitement fades, the stock reverses, leaving the emotional buyers trapped. Real volume, the kind that confirms intent, is steady, consistent, and accumulates as the breakout develops. It doesn't rush wildly, and it doesn't collapse on a minor pullback. Real volume speaks with purpose, and purpose sustains trends. I've observed that in almost every successful breakout, there is a clear story in the volume. It starts subtly, with accumulation or minor increases as informed traders quietly position themselves. Then, as the breakout becomes imminent, volume rises more noticeably, and after the breakout, it continues to support the move as weak hands are shaken out. This is the pattern you want to look for. It tells you that the market is not just reacting, it's thinking, moving with intent, and confirming the breakout with actual participation. Volume can also show you the strength of resistance and support levels. When price approaches a known resistance, watch how volume behaves. If volume increases as it nears the level, it indicates that sellers are preparing to challenge the breakout. If volume remains steady or even accelerates as the resistance is breached, it confirms that buyers are overpowering sellers. Conversely, if volume dries up at resistance, it warns you that the breakout may be false. The market will test its levels, and volume is the first clue to the outcome. One critical aspect of volume is observing the pullback after a breakout. Many traders expect volume to drop completely during a retracement, but what matters is the relative weakness of selling versus prior buying. A modest decline in volume during a pullback shows that sellers are not aggressive, while renewed volume on the next upward push confirms that demand is still present. This is the hallmark of a sustainable breakout. Without this follow-through in volume, the breakout lacks credibility and is likely to fail. It's also important to consider volume in relation to the broader market. When a stock breaks out with strong volume while its sector or peers are lagging, it might still fail. A breakout is more reliable when volume increases in harmony with market trends. If the market itself supports the move and volume confirms it, the breakout has a higher probability of success. Traders who ignore this context often get caught in isolated moves that collapse once the broader trend doesn't cooperate. Volume is not just about total shares traded, it's about participation quality. Large institutional orders, sustained buying pressure, and consistent accumulation all indicate intent. On the other hand, scattered, sporadic trades, or volume spikes that appear only in short bursts, often reflect emotion rather than conviction. You want to be able to differentiate between these two, because the consequences are enormous. Trading without observing this is like sailing a ship without checking the wind. You might move, but you won't move in the right direction. Consider also the patterns that emerge from volume. Rising price on rising volume is the textbook signal of confirmation.